Julie.
We had this big sell-off today. We have yields continuing to push higher. It feels like even after the bad September that we had, that maybe there is still downside here. How should investors be thinking about this?
I think it is a continued momentum in Treasury yields that has certainly stretched well beyond even those on the more sort of pessimistic end of the spectrum as it relates to yields. And it's been part of, obviously, the trifecta of what have been the spike in bond yields, the rising dollar, and until very recently, the move up in oil prices. And it just, I think when you saw that spike go beyond technical levels in the 10-year, it just added to pressure on the downside. And admittedly, though, the rally that preceded it was healthy at the index level, but was very narrow, as we all know. The sell-off has been much broader, and at least as of today, not over yet.
And Lizanne, what does this mean for the consumer as well? The consumer has proven very resilient thanks to that labor market. The consumer's been hanging in there, but now these spikes in rates in oil, the dollar, what do you see your outlook for the consumer, Lizanne? You think continues to prove resilient or some cracks forming?
I think there are some cracks forming. Yes, you did see a revision to savings rate with the comprehensive BEA revisions to overall GDP data, suggesting that there was more sort of excess savings and liquidity that could fund consumption. But we're getting close to the point where that starts to get exhausted. And I also think you can't look at the consumer monolithically anymore. You've got to start to look at income brackets in terms of where pressures are becoming more acute as it relates to the rise in yields. Look at what's going on in things like delinquencies and defaults, particularly, as is usually the case, starting in the subprime category, but then you start to see it move into the upper income categories. You add into the mix the fact that student loan payments are kicking back in. You already mentioned the pressures associated with oil. I think in general, there's been more resilience to the rise in yields because both on the consumer side of the spectrum and the corporate side of the spectrum, a lot of people termed out, they improved their balance sheet, they moved to fixed rate financing from variable rate financing. So that helps to explain why maybe the lags between what the Fed has done and impact on the economy has been longer. I just don't think we're past the expiration date in terms of when they start to show up. And if the labor market weakens further from here, that has been, I think, an important underpinning for that consumer strength, which could start to fade more acutely.
Well, and now it feels like the equity market is anticipating that lag to start to catch up, right? You're one of the best chart watchers out there. What signs are you looking for that these declines might be coming to a close? Or, are we headed to 5% on the 10-year, for example, and further declines in stocks?
So I think momentum is such that, yeah, we could get to 5% on the 10-year. We just had an internal conversation about that today with my colleague, who Kathy Jones, who's our fixed income strategist. All the move up in the yield has been the term premium. It's not been a renewed concern about inflation via inflation expectations, but momentum can pull things in one direction for a while. In terms of what to keep an eye on, it would be those breadth conditions. So we have to remember that a year ago in October, the indexes were taking out their prior lows, which had been in June, but under the surface, breadth was improving. So that's a positive divergence in sort of technical jargon. That's what I'd be looking for, is even if the indexes continue to behave poorly, if you start to see under the surface an improvement in breadth, more of the soldiers marching to the front line versus just the generals, that would be the kind of positive divergence, positive sign that we saw back in October that laid the groundwork for the rally that we got. So breadth statistics, I think, are really important to keep an eye on at this point in the cycle.